Good day. I have taken the data on shares that had lost more than 20% in one day to see what happened next. Perhaps the result of the experiment will help you in making decisions in the face of uncertainty. A bit about the context. Let's consider 50 cases from the US stock exchanges of the biotechnology industry. In 2021, 725 companies of this industry were trading on the US stock exchanges. The total capitalization of the industry decreased by 10% over the year and amounted to just over $1 trillion. The capitalization of 140 biotechs has increased over the 2021, of which 30 companies have more than doubled. On the other hand, 380 companies lost more than 40 of their value in a year. And we are interested in cases when businesses lost more than 20% of their value in one day due to some corporate news and events. This day of fall, the day of collapse, let's call day X. We will have two sections, the highs and lows that the stock price reached in the first 10 days after the fall and from the 11th to 45th day after the fall. The first is the very short-term reaction, and in the second period it is assumed that the negative event is completely digested by the market. Only one thing is important for us: what maximum and minimum levels the price has reached. I will comment on the source data. In 7 cases out of 50, stocks crashed 60–80%. In 15 cases, price dropped 40–60%. 12 cases about a fall by 30–40%, and 18 cases about a fall by 20% in one trading day. Here are the results of the experiment. On the left is a period of up to 10 days. On the right is about the next 35 days. The reference point is the closing price of the falling day. Day X is where 0%. Imagine that at the end of the day, at closing price, investor Tanya bought securities. What can she expect? If Tanya bought in the hope that it would quickly jump out and decided to close the deal as soon as the profit exceeds 10%, okay, 28 times out of 50 it would work. 10% in 10 days. If it is bought in the hope of selling within a month and a half with a profit of 20%, in 23 cases it would have worked out. The probability seems to be close to the game with coin toss. Let's see the minimum prices. In the first 10 days after the fall, the price in 17 cases went below 10% of the close of day X. In the next 35 days, the price fell below 10% in 32 cases, below 20% in 22 cases. This is no longer a coin toss when for the sake of 10 to 20% you can get a negative return on a position for months, or even worse. This is an inadequate risk. It seems to me that these charts reflect nothing more than random fluctuations. Perhaps this is the case. Some companies had big drops in the first 10 days, some had big ups, and some had both. Let's look at special cases with companies. Otherwise, there are only diagrams. We need to look at the graphs. FibroGen, 2 failures in 2021, also by Immunovant. Shares of Insmed Incorporated on May 10 fell by 20% and within 45 days rose by 20% from the closing price of day X. But, as you can see, the price didn't return to the original price. Important to remember, if a $100 stock loses 50%, it will be worth $50. If it rises by 50% the next day, its price will be only $75. You may have noticed on the chart an instance where the price rose a lot more after a sharp drop. August 20, Progenity case. Shares are up 600% from August to November, but this is one case out of 50. People see a collapse of 40%. Buying after such a fall, they probably subconsciously count on these 40%, and even soon. I wanted to show how much time investors lost in similar cases. Also, this data can be useful for those who use pending orders. Volatility is high. Tell us about your experience in the comments and what conclusions can be drawn from the considered charts and graphs. This will help other investors to be more rational, maybe. My name is Nikolai Pomещенко. Thanks for your support. Goodbye.